In 2019, a 38-year-old engineer in Austin quietly stopped going into the office. He had not won anything. He had not sold a company. He had $314,000 in a brokerage account and a portfolio that was paying him $43,000 a year without touching the principal. His employer did not know. His neighbors did not know. And nothing about his balance sheet would have suggested it was possible. For decades, the number everyone agreed on was $1 million. That was the threshold. That was the finish line. It got repeated so often that most people stopped questioning where it came from. Here's where it gets strange. The $1 million figure was never based on how much income you actually need. It was based on assumptions about withdrawal rates that quietly stopped matching how modern income portfolios actually work. So the real question is not how much you need to save. It is how much your portfolio needs to generate. And that changes the math significantly. That gap between the number you were given and the income you actually need is what this video is about. If you do not understand it, you will keep optimizing for the wrong target, saving toward a number that is larger than necessary for longer than necessary. My name is Alex, and if you have ever looked at your savings and felt like the finish line keeps moving, stay with this. Because the $1 million rule was designed around a different era's tax code and a different era's yields. And I'm going to show you exactly how the income math actually works and the specific asset structure that makes $30,000 of annual passive income possible at $300,000. Once you understand how a portfolio is engineered for income rather than growth, you will stop measuring progress in account balances and start measuring it in monthly cash flow. The reason this works comes down to how you layer 4 very different types of income-producing assets. And the sequence of how you stack them matters more than the total amount. Most people build a portfolio the way they pack a suitcase. Everything goes in. A little of this, a little of that. And then they wonder why it doesn't carry what they need. The engineer from the intro didn't stumble into $300,000 of income-generating capital and get lucky. He thought about it differently. Instead of asking, "What should I invest in?" he asked a different question. "What job does each part of my portfolio need to do?" That reframe changes everything, because a portfolio built for income is not one big pool of money. It's 4 separate layers, each with a specific role, and the way you stack them determines whether the whole thing holds together or falls apart when markets get ugly. Think of it like the foundation of a building. You don't pour the same concrete at every level. The ground floor has to be different from the upper floors. Each tier carries a different load. Start at the bottom. The first layer is cash and equivalents. High-yield savings accounts, treasury bills, and short-term CDs. Nothing exciting. Currently, the best high-yield savings accounts are paying somewhere between 3 and 5% annually, depending on the institution. That is not going to generate life-changing income on its own. But here's the thing. That's not its job. Its job is to exist when everything else breaks. When the stock market drops 20% and you need to cover your living expenses for the next 12 months. Tier 1 is what you draw from. Without it, you are forced to sell your income-producing assets at exactly the wrong time, locking in losses to pay your rent. A lot of people miss this. They see a 3 or 4% yield and think it's not worth holding. But a buffer that prevents you from selling your best assets at the bottom of a crash is worth far more than its stated return. Stability has a price, and this is how you pay it. The second layer is where the reliable cash flow lives. Dividend ETFs. Funds like SCHD and VYM, alongside individual blue-chip stocks with long, unbroken payout histories. Consider Coca-Cola. This year marks their 64th consecutive annual dividend increase. 64 years. That includes the dot-com crash, the 2008 financial crisis, a global pandemic, and every recession in between. They raised the payout through all of it. SCHD currently yields around 3.5%. Not spectacular on its own, but the growth is what matters. A position that yields 3.5% today and grows the payout by 10% annually doubles your effective yield in roughly 7 years, without you adding a single dollar. This layer also acts as a stabilizer. When the high-yield parts of your portfolio are swinging around, and they will, Tier 2 barely moves. It's the part of the machine that keeps running when the rest is noisy. Now, is this combination enough to live on? If you're starting with $300,000, no, not at these yields, which is why the next 2 layers exist, and why understanding how those layers generate income, specifically the tax mechanics behind them, is the part of the strategy that most people completely overlook. That's where we need to go next, because how your dividends get taxed can quietly erase a third of your income before you even see it. And avoiding that trap comes down to understanding one specific distinction between two types of passive income. Here's something most income investors never think to ask. Two portfolios, same size, same total distributions paid out each year. One keeps significantly more of it. The only difference is 3 letters on a tax form. Consider a nurse in Phoenix, mid-40s, disciplined saver, finally got her brokerage account to the point where it's generating real income. $42,000 a year from her dividend portfolio. She built something most people never get to. And then she sat down with her accountant in April and realized she had kept less than $30,000 of it. The IRS had quietly taken the rest, not because she did anything wrong, because she didn't know the difference between the two types of income that look identical in her account, but are taxed at completely different rates. This is the tax trap, and it's the part of the income portfolio conversation that rarely gets mentioned until it's too late. Here's how it actually works. The IRS splits dividend income into 2 categories: qualified dividends and ordinary dividends. The names sound like they belong in a legal document, but the concept is simple. Qualified dividends come from U.S. companies, where you've held the stock for a minimum period, generally more than 60 days around the payout date. Those get taxed at long-term capital gains rates. Currently, that means 0%, 15%, or 20%, depending on your total income. For most people, in the $42,000 annual income range we've been designing toward, the effective rate on qualified dividends is 15%, sometimes lower. Ordinary dividends don't meet those holding criteria. They get taxed as regular income, the same as your salary, your freelance work, your bonus. Depending on your bracket, that rate currently runs anywhere from 22 to 37%. Run that math on $42,000 of annual distributions. At 15%, you keep $35,700. At 30%, you keep $29,400. That's a $6,300 gap per year, just from the tax classification. Over a decade, that's $63,000. Not from a bad investment, from a paperwork distinction most people don't know to look for. Now you're probably thinking, fine, I'll just hold qualified dividend stocks and stay in Tier 2. And yeah, that works well for that layer. But here's where it gets more interesting, because there's a third category entirely, and it's the one that makes Tier 3 possible. It's called return on capital, or ROC. And when you first hear the phrase, it sounds like something went wrong, like the fund ran out of real income and started handing your own money back. That reaction is understandable. It's also incorrect. ROC is a tax classification, not a performance signal. When a fund distributes income classified as ROC, you don't pay tax on it in the year you receive it. Instead, it reduces your cost basis, the original price you paid for the investment. The tax bill gets deferred until you eventually sell the shares. And if you've held those shares for more than a year at that point, the gain gets taxed at long-term capital gains rates anyway. Let me give you a concrete example. Say you bought into a covered call ETF at $50 a share. Over the following year, it pays out $8 per share in distributions, all classified as ROC. You received $8 in cash. You paid 0 tax on it that year. Your cost basis dropped from 50 to 42. The IRS will eventually collect, but not until you sell, and potentially at a more favorable rate than ordinary income. For someone living on portfolio income month to month, this matters enormously. You receive the full distribution in cash. You cover your expenses with it. The tax event happens years down the road, when you control the timing. That's not avoidance. That's deferral, and it's entirely by design. This is why the structure of Tier 3 isn't just about generating high yields. It's about generating high yields in a way that doesn't immediately hand a third of them to the federal government. The covered call funds sitting in that tier are specifically built around this mechanism, which raises the obvious next question. Given all of this, how much passive income does the average person actually need to walk away from their job? And what's the real target income number to design toward? That's exactly what we need to figure out before the blueprints make any sense. And the answer is more specific than most people expect. Nobody ever asks the right question first. Before you decide how much money you need in a portfolio, you have to answer something more basic. How much income do you actually need to replace? It sounds obvious, but most people skip it entirely. They hear $1 million and start calculating how long it'll take them to get there, without ever stopping to ask whether that number even maps to their real life. The target came first. The math came second. That's backwards, and it's why a lot of people are saving toward a number that has nothing to do with their actual situation. So let's build the number from scratch. There's a standard rule of thumb in retirement planning that says you need roughly 80% of your working income once you stop working. The logic is that certain expenses disappear: commuting, work clothing, some taxes. So you don't need a full replacement of your salary, just most of it. The 80% figure isn't perfect, but it's a reasonable starting point, and it's widely used by financial planners for exactly that reason. Currently, the US median household income sits around $87,000 to $88,000 a year, based on the most recent estimates. Take 80% of that, and you land at roughly $70,000. That's your gross income replacement target. Write that number down. Now, here's where it gets more useful, because $70,000 is not what you need your portfolio to generate. Not if you're also receiving Social Security or have access to any kind of pension. The average Social Security retirement benefit currently runs about $2,080 a month. Over a full year, that's around $25,000. It's not a fortune, and it's not designed to be. But it's also not nothing. For the purposes of this calculation, let's use a conservative $24,000 annually, which covers a wide range of claimants and doesn't assume the maximum benefit. Subtract that from your $70,000 target. Your portfolio now only needs to generate $46,000 a year. Think about what that shift means. You didn't change your lifestyle. You didn't lower your expectations. You just accounted for the income you're already entitled to receive. And your portfolio target just dropped by more than a third. Now, I want to acknowledge something here. If you're reading this in your late 30s or early 40s, you may be skeptical about Social Security. That's a reasonable feeling, and the debate about the program's long-term solvency is real. But even if you apply a significant discount, say you only expect to receive $15,000 a year rather than $24,000, your portfolio target still only needs to produce $55,000 annually. That's a very different number from $1 million at a 4% withdrawal rate, which is where most people's heads go by default. Let me give you a concrete example of how this plays out. A project manager in Columbus, 41 years old, earns around $90,000 a year, has been disciplined about saving for a decade, runs the conventional math, and tells himself he needs $1.2 million before he can even think about leaving his job. That number feels so far away that he stops thinking about it seriously. He's not wrong about the math. He's wrong about the inputs. When he runs the calculation the right way, accounting for the Social Security he'll receive, applying the 80% income replacement rule, and targeting the actual income gap rather than a gross portfolio number, his real target drops to around $460,000. That's still meaningful, but it's a very different conversation. The finish line moved. Here's the actual takeaway. The number you need your portfolio to generate is not your salary. It's your salary replacement minus every other income source you already have coming. Everything else is overshoot. For the purposes of the blueprints we're about to walk through, we'll use $42,000 per year as the target. That's the real income gap for a household near the median, and it's specific enough to build around. And building around it is exactly what the exact portfolio blueprints in the next section do, showing you precisely how different account sizes, from $300,000 all the way up to $1 million, are structured to hit that number reliably. The same target income, 3 completely different portfolio sizes, and all 3 of them can get there. What changes is not the destination, it's how much risk you have to carry along the way. That tension is worth sitting with for a second, because when most people think about building an income portfolio, they think about it as one thing, one account, one strategy. They don't think about it as an engineering problem where the structure changes depending on the resources available, but it does. And understanding that is what separates the blueprints that actually hold together from the ones that look good on paper and fall apart in a down market. So let's walk through 3 versions of the same machine. Start at $300,000. This is the minimum viable number for the $42,000 annual income target, and you need to understand upfront that hitting it at this level requires accepting real risk. There is no cushion here. You are going almost entirely into Tier 3. The covered call ETF we looked at earlier. 60% into QQQI, the NEO's NASDAQ 100 High Income ETF, which is currently yielding around 14% annually, 20% into SPYI. The NEO's S&P 500 High Income ETF is currently in the 11 to 13% range, and the remaining 20% into BTCI, NEOS's Bitcoin-linked covered call ETF, which targets similar yields with added exposure to crypto market volatility. Run those numbers. $300,000 deployed across those three funds at a blended yield of roughly 16 to 17% generates somewhere between $48,000 and $51,000 per year in distributions. That clears the $42,000 target. But here's the uncomfortable truth about this setup. There is no Tier 1 buffer. There is no Tier 2 stability layer. If markets drop sharply, and the NASDAQ has done that twice in the last 15 years, you have nothing to draw from except assets that are currently falling in value. You would either sell at a loss or live off less income until things recover. That's the trade-off you accept at this level. The math works. The resilience does not. This is a version of the machine built for someone who has no other option but to run it at full throttle. Now watch what changes at $500,000. This is where the portfolio starts to behave differently, because with $200,000 in additional capital, you no longer need to push every dollar into the highest yielding assets to hit your target. You can afford to build a real structure. 30% goes into solid dividend ETFs, like SCHD, your Tier 2 foundation, generating around 3.5% in stable, qualified dividend income. 50% goes into covered call ETFs, split between QQQI and SPYI, doing the heavy income lifting. 10% goes into the S&P 500 for long-term capital preservation, and the final 10%, a small position, goes into a speculative instrument like STRC Strategy Inc. This variable rate preferred stock, currently yielding 11.5% and resetting monthly. Total annual distributions on that structure, somewhere above $44,000. You've exceeded the target, but more importantly, you've built something that has actual layers. You have a stable base that doesn't move much when markets get rough. You have a growth component that keeps pace with inflation over time. And you have a small, contained speculative position that adds income without putting the whole structure at risk. The machine runs more smoothly because it has different gears doing different jobs. A note on STRC specifically, since it's the most unusual name in this list. It's a perpetual preferred stock issued by Strategy Inc., a company whose balance sheet is almost entirely composed of Bitcoin. STRC pays a monthly variable dividend, currently 11.5% annualized, and the rate resets each month to keep the share price near par. The company has continued paying that yield through significant Bitcoin volatility, but the risk is real, and it is specific. If Bitcoin collapses severely and Strategy faces financial distress, preferred holders would take a hit before any Bitcoin recovery helps them. This is not a Tier 2 holding. It is a Tier 4 position. Sized accordingly, 5 to 10% of a portfolio, it contributes meaningfully to income without threatening the whole structure. At $1 million, the same basic architecture scales cleanly. The weighting stays similar. A heavy dividend ETF foundation, covered calls doing the core work, a slice of growth, a small speculative position. But the numbers look very different. A well-structured $1 million portfolio at these yield levels can generate somewhere above $105,000 a year. That's more than double the $42,000 target. It is, genuinely, enough to live on without touching your principal in most parts of the country, without significant lifestyle compromise. That said, there is one thing this entire section has assumed without saying it out loud, that you already have the capital. The saving phase is done, because the strategy that works beautifully for generating income from a built portfolio will quietly damage a portfolio that's still trying to grow. And that's the crucial growth warning we need to address before anything else. There is a version of this strategy that quietly destroys the thing it's supposed to build, and most people never see it coming because it looks, on the surface, like exactly the right move. Here's how it happens. Someone in their early 30s comes across the portfolio blueprints from the last section. The numbers make sense. The yields are real. They run the math, realize they could be generating meaningful passive income within a few years, and immediately start allocating into QQQI, SPYI, and a few high-yield covered call funds. Distributions start arriving monthly. It feels like progress. It feels like the machine is running. It isn't. Not yet. Here's the distinction that matters more than almost anything else in this entire video. There are two completely separate phases in building an income portfolio. The growth phase, where you are accumulating capital, and the income phase, where you are living on it. The assets that work brilliantly in phase 2 will silently sabotage phase 2 if you deploy them in phase 1. And the reason comes down to something most people don't fully appreciate until they've lost years to it. It's called tax drag, and it is the silent killer of compounding. When you invest in a standard growth fund, say a total market index fund or the S&P 500, the gains accumulate inside the fund. You don't pay tax on them until you sell. That means every dollar of appreciation stays invested, continues compounding, and only becomes a tax event when you decide to trigger one. You are in full control of the timing. High-yield income funds work the opposite way. Every month, they distribute cash. QQQI pays out its distributions monthly. SPYI pays monthly. STRC pays monthly. That cash hits your account, and if you're in a taxable brokerage, which most people in the accumulation phase are, that distribution becomes a taxable event whether you wanted it to or not, even if you immediately reinvest it, even if you didn't need the income. The IRS doesn't care that you weren't trying to use the money. You received a distribution, and now you owe tax on it. Let me show you what that costs. Take a 34-year-old software developer in Denver, disciplined saver, puts away $2,500 a month, has been doing it for 3 years, and currently has around $90,000 invested. She reads about QQQI's 14% yield and moves her entire portfolio into it. She reinvests every distribution. She is not spending any of it. She genuinely believes she is compounding aggressively. Here's what's actually happening. Every year, at a 14% distribution rate on a growing portfolio, she is generating roughly $12,000 to $15,000 in taxable distributions annually. At her income level, those distributions are taxed somewhere between 22 and 24%. That's $2,600 to $3,600 a year going to taxes on income she never actually used. Over 10 years, assuming her portfolio grows to around $300,000, she will have paid somewhere in the range of $25,000 to $35,000 in unnecessary taxes, taxes she would not have owed in a growth-focused fund, simply because she was generating income before she needed it. That is not a minor inefficiency. That is a compounding headwind that runs for a decade. The right tool for the growth phase is a low-cost, low-distribution index fund, something like VOO or VTI, funds that track the broad market, grow with it, generate minimal taxable distributions, and let compounding do its work undisturbed. The goal during accumulation is not to generate income. The goal is to build the asset base from which you will later generate income. Those are two different objectives, and they require two different instruments. Think of it this way. The blueprints from the last section are not a starting point. They are a destination. You build toward them. You do not start in them. The question worth sitting with, and it's the one that ties everything in this video together, is which phase you're actually in right now. Not which phase you want to be in. Not which phase you imagine yourself in. The one you are actually in. Because the answer determines which version of this strategy belongs in your portfolio today, and which one belongs in your future. That reflection is exactly what the conclusion is designed to help you land on. Here is what this video really came down to. The $1 million number was never wrong exactly. It was just answering a different question than the one you actually need to ask. The question is not how much you need to save. It is how much your portfolio needs to generate. And once you reframe it that way, the target becomes significantly smaller, and the path becomes significantly clearer. A few things worth holding on to. First, structure matters more than size. A $300,000 portfolio built correctly outperforms a larger one built carelessly. Second, how your income is classified determines how much of it you actually keep. Third, the assets that generate income and the assets that build capital are not the same instruments, and using them interchangeably is where most people quietly lose years. Fourth, the real target income number is almost always lower than the number people assume, because they forget to subtract the income they're already entitled to receive. Before your next investment decision, ask yourself one question. Am I currently building the machine, or am I ready to run it? There is a related question this video didn't answer. What happens to this strategy when interest rates shift significantly? That one is worth understanding next.